Speak. Most growth strategies are built on incomplete math. Break time 180 milliseconds. Behind every aggressive expansion, there's a quiet erosion of resources no one talks about. This shift is happening in boardrooms and startups alike, silently eating into long-term stability. It directly impacts your investments, career moves, and business decisions. The numbers you see don't capture the full cost of chasing growth. Understanding these hidden factors is crucial to avoiding costly mistakes. There's a pattern to this, to how these blind spots develop and spread. The details behind this pattern reveal why common advice is often misleading. By the way, this channel shares one bold insight like this every week. If this perspective is useful, consider subscribing. When companies double down on growth-focused strategies, the conversation rarely drills into the real price tag attached to scaling up. Everybody talks about revenue spikes, market share grabs, and the shiny metric of user acquisition, but few pause to analyze the hidden costs that quietly erode those gains. This blind spot has become especially dangerous in today's hyper-competitive, resource-constrained environment, where rapid expansion isn't just a strategy, it's often a gamble on survival. The reason this shift matters now is that businesses no longer operate in a vacuum. Break time 180 milliseconds. Every move to expand triggers ripple effects, operational inefficiencies, employee burnout, and overlooked compliance risks that compound quietly before the next earnings call. What's particularly striking is how this erosion of resources shifts power dynamics inside organizations. Break time 180 milliseconds. Leaders fixate on hitting growth targets, but middle managers and frontline employees bear the brunt of the strain. What's particularly striking is how this erosion of resources shifts power dynamics inside organizations. This creates a disconnect where decision-makers chase top-line numbers while the execution layer quietly fractures under unreported pressures. That misalignment fuels turnover rates, drains institutional knowledge, and disrupts any attempt at sustainable innovation. Investors might celebrate revenue milestones without realizing that the foundation crumbles beneath the surface, making those milestones unreliable signals of health. On a broader scale, this pattern reshapes industry competition in subtle but impactful ways. Companies that opt for rapid growth without accounting for hidden costs end up vulnerable to shocks, be it regulatory scrutiny, supply chain disruptions, or sudden shifts in consumer behavior. Meanwhile, competitors who prioritize resilience and operational discipline might grow slower but build defenses that pay off when volatility hits. The markets reward headline-grabbing expansion in the short term, but the underlying vulnerabilities can translate into sudden collapses or forced retrenchment, reshuffling competitive landscapes faster than anyone anticipates. There's also a critical geopolitical angle here. As companies globalize to chase growth, they expose themselves to regulatory environments and political risks that aren't reflected in growth metrics. Compliance issues that arise in distant markets can create expensive legal battles, sanctions, or forced market exits. This risk is systematically underestimated because it's not immediately visible in quarterly earnings, yet it can wipe out years of growth in an instant. The allure of rapid international scale blinds many to how fragile these cross-border operations truly are. Finally, this growth obsession distorts innovation incentives. When hitting aggressive targets becomes the obsession, R&D and long-term experimentation take a back seat to short-term hacks that boost user numbers or revenue quickly. That's why you see so many companies chasing incremental features or marketing gimmicks instead of breakthrough products. Over time, this leads to stagnation masked by superficial growth. Companies become masters of scaling yesterday's ideas rather than inventing tomorrow's markets. The real cost here is not just financial, but strategic, a loss of future relevance disguised by today's inflated numbers. Digging deeper, this pattern of prioritizing rapid growth also warps talent pipelines in a way most people fail to recognize. When organizations chase aggressive expansion, hiring often accelerates without a clear strategy for developing or retaining employees. This leads to a revolving door of talent, where onboarding speeds up, but depth of skill and cultural cohesion deteriorate. The consequence is a workforce that looks impressive on paper, but struggles to execute complex problems or innovate thoughtfully. For individuals, this means job hopping becomes more common, and companies lose the ability to cultivate leaders who can navigate the next phase of growth. The long-term effect? A chronic leadership deficit that undermines organizational adaptability. Another overlooked implication lies in capital allocation. Growth-driven companies frequently funnel resources towards scaling operations or marketing at the expense of infrastructure and risk management. This creates a dangerous imbalance where short-term gains overshadow the building of robust systems, like cybersecurity, quality controls, or supply chain resilience. When underinvestment in these areas collides with a crisis, the fallout can be catastrophic and swift. Investors who focus purely on top-line growth miss how fragile the business model becomes without these foundational investments. This disconnect inflates valuations, but embeds ticking time bombs that can erase shareholder value overnight. The obsession with growth metrics also reshapes corporate governance dynamics, often concentrating power in the hands of CEOs and boards fixated on quarterly numbers. This pressure can marginalize voices advocating for caution or structural reforms, fostering an echo chamber that dismisses dissent as resistance to progress. In this environment, risk oversight weakens, and ethical corners get cut, increasing the likelihood of scandals or regulatory breaches. For stakeholders, this means that apparent growth can be built on shaky ethical ground, ultimately exposing companies to reputational damage and legal penalties that far outweigh any short-term gains. Lastly, at the consumer level, this relentless growth drive subtly shifts product and service quality. As companies prioritize scaling user acquisition and engagement metrics, user experience often becomes secondary. This manifests in cluttered interfaces, intrusive advertising, or lowered customer support standards. Choices made to boost short-term revenue rather than nurture long-term loyalty. Over time, these compromises erode brand trust and open the door for more patient competitors to capture disillusioned customers. The paradox: rapid growth strategies can sow the seeds of their own decline by alienating the very audience they seek to expand. There's a less obvious but equally destabilizing force at play: the psychological toll on employees trapped in this growth treadmill. Constant pressure to meet escalating targets fosters a culture of fear and risk aversion masked as urgency. People stop speaking up about flaws or ethical concerns to avoid being labeled as blockers. This dynamic suppresses creativity and breeds groupthink, making organizations less adaptable to unexpected challenges. Over time, the collective burnout and disengagement don't just hurt morale, they degrade decision-making quality at every level, turning once promising companies into brittle hierarchies that crumble under stress. Digging into investor behavior reveals an unsettling feedback loop. Wall Street's obsession with sensational growth numbers incentivizes companies to prioritize optics over substance. Executives might inflate user counts through questionable tactics or delay disclosing operational issues to preserve stock prices. This creates a game of smoke and mirrors where short-term market reactions overshadow fundamental health. For the average investor, this means trusting headline metrics can be a trap. Behind the scenes, the real story is often one of mounting risk, obscured by polished quarterly reports. The ripple effects extend into the startup ecosystem itself. Early-stage companies pressured to scale prematurely often sacrifice product-market fit and sustainable business models for rapid user growth. This leads to a wave of burnouts and failures that skew venture capital dynamics toward chasing the next unicorn rather than building durable enterprises. The consequence is a distorted innovation landscape where capital flows to hype and momentum instead of resilience and long-term value creation, ultimately limiting the true potential of technological progress. Meanwhile, regulatory bodies struggle to keep pace with this hyper-growth mentality. As companies push into new markets and technologies at breakneck speed, oversight frameworks lag behind, creating gaps in consumer protections and market fairness. This regulatory lag not only exposes end users to risks, but also sets the stage for sudden crackdowns or heavy fines that can derail growth trajectories overnight. The mismatch between rapid expansion and slow policy responses adds another layer of systemic vulnerability that's rarely factored into the equation.